Welcome back to the deep dive. Today, we are opening the hood on Texas Instruments Q3 2025 financial reports. TI isn't just, another chip company. They are really the bedrock, the foundational supplier for these analog and embedded processing chips, the ones that run pretty much the global industrial complex, everything from automotive safety systems to automated factory floors.
That's exactly right. If you want a quick, kind of accurate pulse check on the health of the entire industrial and automotive semiconductor world, well, this TI report is basically it. So our mission today is to cut through all that data density, find the really crucial strategic points, like what drove this quarter's huge revenue growth, how are government incentives, the CHS Act, actually hitting their bottom line, and what's management signaling about the demand cycle ahead, because that's critical.
Right. And the aha focus for you, the listener, is really twofold here. First, you need to recognize this strategic trade-off TI is making. They're sacrificing some short-term margin, it seems, for massive subsidized long-term capacity. And second, just understanding how deeply the U.S. CHS Act has already become, well, a financial accelerator for making chips here in the U.S.
Okay, so let's look at this snapshot for Q3 2025. TI reported revenue of $4.74 billion, net income landed at $1.36 billion, and earnings per share, or EPS, that came in at $1.48.
And we have to note that EPS figure, it came with a specific caveat, didn't it?
Correct, yeah. That $1.48 EPS included a 10-cent reduction. And management specifically pointed out this was not factored into their original guidance. So even swallowing a headwind like that, the underlying financial performance was remarkably strong.
The CEO, Haviv Ilan, he sounded pretty enthusiastic. He highlighted that revenue increased a strong 7% sequentially, quarter over quarter, and a very robust 14% jump year over year. And he specifically said they saw growth across all end markets. That sounds like a strong signal. Maybe that inventory correction is finally behind us for a lot of industrial customers.
Yeah, it could be. And when you look at the raw quarterly comparison, Q3 25 versus Q3 24, the top line definitely tells a story of acceleration. Revenue jumped from about $4.15 billion last year right up to $4.74 billion this year. That's a clear 14% rise.
Okay, so that level of revenue growth, normally you'd expect that to flow straight through to the bottom line, right? Series profitability. But when we look at the profit metrics, well, the connection gets a bit frayed. Operating profit grew, a decent 7%. Went from $1.55 billion to $1.66 billion.
But yeah, net income tells a far flatter story. It was essentially zero growth year over year, just hovering right around $1.36 billion. And the EPS reflected this kind of sluggishness, increased just 1% from $1.47 to $1.48. So that raises the big question. Why did strong revenue growth translate into, flat net income?
Exactly. That disconnect is the key thing to analyze here. If TI is selling 14% more stuff, where did the profit go?
Well, it seems to be a function of cost absorption and strategic investment. If we dig into the cost drivers, the first big factor holding down net income was the cost of revenue, the immediate cost of making the products. That number was up significantly. It rose from about $1.68 billion in Q3 24 to over $2 billion in Q3 25. $2.019 billion to be exact. That's a steep, sharp increase.
Is that steep rise in cost of revenue just like a necessary evil, reflecting the cost of ramping up new factories? Or is it more about current inflation hitting materials and labor?
It's likely a mix, I'd say, but strategically, a lot of it probably relates to the cost of getting to future scale. They are aggressively building out capacity, right? And those costs, they hit the cost of revenue line immediately before you get the full efficiency benefits. It's a trade-off. They're investing for tomorrow, which puts pressure on today's profitability.
Okay, and there was a second major factor too, a one-time hit.
Correct. An $85 million restructuring charge that landed smack dab in Q3 2025. And there was nothing, zero, like that in the prior year's quarter. So when you combine significantly higher operating costs from, scale and ramp up with a pretty substantial one-time restructuring charge, well, it basically absorbs every dollar of profit that 14% revenue growth generated. It looks like a controlled sacrifice of current margins for long-term structural change.
Okay, that framing makes the flat net income look less like, a failure and more like a deliberate consequence of these big long-term strategic moves. All right, let's shift gears to cash, because this is where the story gets really compelling, I think. This is where the CHS Act benefits start to really show up.
Exactly. And what's fascinating here is looking at their operational strength using the trailing 12 months data, the TTM data For listeners maybe less familiar, TTM just looks back across the last 4 quarters, gives us a clearer picture of sustained momentum, kind of smooths out any single quarter blips.
And looking at that TTM cash flow from operations,
Yeah.
wow, the strength of the underlying business model is just underscored dramatically.
It certainly is. Cash flow from operations hit $6.9 billion TTM. That's a 10% increase year over year. I mean, that is a foundational level of operational cash generation that very few companies can match.
Well, the really eye-popping number, the one that made me look twice, was free cash flow, or FCF.
Yeah.
This metric saw a monumental surge. But we have to be super clear about how TI calculates it, right? Because this is where those government incentive dollars get folded in.
This is critical, yes. TI defines FCF as a non-GAAP measure. It's cash flow from operations minus capital expenditures, plus proceeds from USCHIPS and Science Act incentives. That last addition, that's the key difference from how maybe others calculate FCF traditionally.
Okay. And when you include those incentives, the TTM FCF figure saw this huge, massive surge. It reached $2.4415 billion TTM. That represents a, frankly, breathtaking 65% change from the previous year's $1.468 billion TTM figure. Just wow.
Yeah, and FCF as a percentage of revenue, which is a great measure of efficiency, it jumped from 9.3% up to 14.0%. This huge leap, well, it's the direct, quantifiable economic injection from government policy, the policy designed to boost domestic manufacturing capacity.
Can we break down the GTS Act impact just for this single quarter? Like how much actual cash flowed in during Q3?
Absolutely. For Q3 2025 alone, TI recorded $75 million in proceeds directly from GTS Act incentives hitting their cash flow. However, the total cash benefit related to the GTS Act for the quarter was even higher. It was $118 million.
Okay, wait, where did the extra money come from? $75 million plus? Where's the rest?
The remaining $43 million came from using an investment tax credit, or ITC. Also related to the Cheat 6 Act, TI used that credit to reduce its income taxes payable. So that full $118 million is real cash, either received directly or, retained because they paid less tax, all thanks to the government's support for their capacity build-out. This isn't theoretical future stuff. This is real money fueling their strategic spending right now.
Okay, so we've established the foundation is strong, cash flow is booming, and it's being amplified by government support. The next logical question has to be, how is TI translating all that massive subsidized liquidity into future growth? And how are they rewarding their owners at the same time?
Well, the management commentary tied this directly to their big strategic manufacturing choice, the benefit of 300mm production. For the listener, 300mm just refers to the diameter of the silicon wafer they build chips on. Moving to 300mm lets manufacturers get far more chips out of each wafer compared to the older, smaller 200mm standard. It's really the modern standard for high-volume, cost-efficient manufacturing.
That makes perfect sense. They're modernizing to get the best possible future cost structure, and they are backing this push with, frankly, staggering amounts of money.
Oh, yeah. Over the trailing 12 months, the investment is just immense. They put $3.9 billion into R&D and SG&A, that's selling, general, and administrative costs. That fuels future products and the sales infrastructure.
But the commitment to the physical stuff, the factories, the equipment, that's where the number truly shocks, I think. Talk about CapEx figures all the time on these deep dives, but $4.8 billion invested in capital expenditures over the last 12 months for just physical infrastructure. That's a serious level of commitment. That's putting your money where your mouth is.
It is a phenomenal bet on future demand. And it's a key reason why their net income was flat, like we discussed. They are absorbing massive ramp-up costs and depreciation right now, banking on huge returns once these new 300mm facilities are fully up and running.
Right. But despite those huge investments, the commitment to shareholders remains, well, absolute it seems. Over the TTM, total cash return to owners was $6.560 billion. That's a solid 26% increase over the prior year TTM.
And this is where the strategic balancing act gets really interesting, isn't it? They return more cash to shareholders, $6.56 billion, than the $4.8 billion they spend on CapEx.
And within those returns, we saw kind of two different strategies playing out. Dividends increased steadily, like you'd expect, a standard 4% bump. That brought the quarterly declaration up from $1.30 to $1.36 per share. Pretty standard stuff. But the stock repurchases, wow, they jumped 253% TTM.
That is probably the most dramatic financial signal in the entire report, I'd argue. They went from repurchasing about $457 million worth of stock TTM last year to $1.611 billion TTM this year. This is management basically making a loud statement. They believe their cash generation capability, even after shelling out that huge $4.8 billion in capex, is so strong. And maybe that their stock is so undervalued right now that returning this massive quantity of cash via buybacks is the absolute best use of capital.
Yeah, it speaks volumes about their confidence, doesn't it? Confidence that the government subsidies and that 300-millimeter switch will eventually pay off with huge dividends, making the stock look cheap right now. Okay, let's shift to the operational breakdown by segment, because even with the CEO saying all markets were up, the profitability story wasn't quite uniform across the board.
Right. The analog segment, that remains the clear powerhouse. No surprise there. Revenue grew 16% to $3.729 billion, and its operating profit grew a healthy 13%. So this segment is performing exactly as you'd hope. It's dominating the industrial and automotive space, really driving that overall revenue growth. This is the stuff that runs everything from, automated warehouses to electric vehicle charging controls.
Okay, but then we look at embedded processing. Revenue grew a solid 9% to $709 million. That's decent growth. But here's the strategic wrinkle. Its operating profit actually decreased by 1%. It settled at $108 million. Why the margin compression in that specific segment?
That suggests one of two things, possibly both. Either they're facing some pretty intense pricing pressure in specific embedded markets, or, maybe more likely, they are channeling significant R&D investment through that segment right now, spending money to develop the next generation of embedded controllers. Since the stated goal is long-term dominance, they might just be willing to swallow short-term profit dips in embedded processing to capture future market share down the road.
Okay, that makes sense. And finally, the other segment. Revenue grew 11%, but its operating profit dropped sharply, down 47%.
Yeah. That segment clearly bore the brunt of that $85 million restructuring charge we talked about earlier. It just shows how concentrated those one-time costs were, while the two core segments, analog and embedded, absorb more of the ongoing cost of revenue pressures from the ramp-up.
Okay, got it. So that brings us to the forward look, the outlook. If the CEO said Q3 saw growth across all end markets, why does the Q4 guidance seem to suggest a sequential decline? Is this signaling genuine softness ahead, or is this maybe just the typical TI management conservatism, sometimes called sandbagging expectations?
It's a very good question, and they are definitely signaling some caution ahead. TI forecasts Q4 2025 revenue in the range of $4.22 billion to $4.58 billion. The midpoint of that range is definitely a sequential step down from Q3's $4.74 billion. And the corresponding EPS forecast is similarly restrained, projected somewhere between $1.13 and $1.39.
So ever a really massive jump in Q3, they seem to be factoring in maybe some inventory correction catching up, or perhaps broader macroeconomic softness kicking in for Q4. It feels a bit like they're managing expectations after hitting such a high watermark this quarter.
They are managing expectations, yes, while simultaneously laying out the strategic risk profile very clearly. In their forward-looking statement section, the fine print, they clearly caution that actual results could differ materially based on unpredictable economic, social, and political conditions, including global trade policies. Standard stuff, but important.
But the most relevant risk, I think, given everything we've just discussed, is tied directly back to their huge strategic bet on capacity. They specifically warn that results could differ if market demand for semiconductors, particularly in those foundational industrial and automotive markets, differs from their internal forecasts.
Exactly, and this ties directly back to that enormous $4.8 billion capex figure. The final risk they highlight is about, and I'm quoting loosely here, our ability to realize expected returns on significant investments in manufacturing capacity. They are betting huge sums on these new 300-millimeter factories, and the only real payoff comes if future industrial and automotive demand actually materializes exactly as they project. The entire long-term thesis really hinges on that expensive new capacity being fully utilized down the line.
Okay, so to summarize this deep dive, TI just delivered a quarter showing immense underlying operational strength, especially in that core analog segment. And that strength was buttressed significantly by substantial CPS Act incentives, which fueled that really massive surge in free cash flow we saw.
Right. And they are simultaneously investing incredibly aggressively, pouring billions into state-of-the-art 300-millimeter manufacturing to try and secure future cost dominance, while also rewarding shareholders with historically high cash returns, including that absolutely spectacular 253% jump in stock repurchases over the last year.
But this high-wire act, it comes with immediate consequences, doesn't it? We saw flat short-term net income because of those high ramp-up costs and the restructuring charges, and we see a cautious outlook now for Q4.
Mhm. So here's the final provocative thought for you, the listener, to kind of chew on. TI is explicitly highlighting these massive cash benefits they're getting from the GTS Act while simultaneously investing that colossal $4.8 billion in capital expenditures. Now, given that they specifically warn that one of the major risks is not realizing the expected returns on these significant investments, how much of today's really strong cash flow is essentially just a strategic outlay? A huge multi-year gamble on massive future capacity needs, particularly in the automotive and industrial sectors.
That tension right there, the current financial prowess funding this high-stakes bet on future capacity, that is the core dynamic you really need to watch in TI's reports over the coming quarters. That's the deep dive for today. Thanks for exploring the numbers with us.